Guys, welcome back to our lecture on real estate investment trust. I am confident that your understanding has improved after watching the last two lectures on REITs. So far, we've been looking at a couple of interesting things in relation to REITs. We've looked at the concept of a REIT. We've looked at the different types of REITs. We've looked at the stages of REIT regime maturity. We've looked at the REIT market in terms of its size and performance. And in the second lecture, we ended on the rules governing the establishment of REITs and the distribution of REIT income. There are two main topics I need to treat to end this topic. The first one being how to measure REIT income, and the second being how to value REIT income. In this third lecture, I will focus on how to measure REIT income. Let's look at the details. To satisfy the requirements to be a REIT, 90% of net income must be passed through to shareholders as dividends, oftentimes. However, when analyzing a REIT, net income is not considered by many analysts as the true earnings of a company, but is thought of as an accounting convention, as we will come to realize later on. Other alternatives to net income, like funds from operations and adjusted funds from operations, have become widely accepted by REIT analysts as being more effective measures of true earnings, and this will be discussed in this section. So, the question I'd like to pose at this time is, how do we measure REIT income? From the brief introduction I have given, you will realize that there are at least three main ways to measure REIT income. These three main ways are: 1. The use of the net income based on the generally accepted accounting principles, or GAAP. 2. The use of the funds from operations. And 3. The use of the adjusted funds from operations. Now let's look at the details of each of these ways of measuring REIT income. Let's start with net income. For any company, net income is defined using generally accepted accounting principles as revenues minus operating expenses, depreciation and amortization, interest expense, and general and administrative expenses. Now, when we think of funds from operations, we are saying that it is a measure that has become widely accepted by analysts and investors, and more closely represents recurring income from property ownership for REITs than net income. It should be noted here that there are many interpretations of how to convert net income to funds from operations, and that different REITs apply different conventions, making it difficult at times to compare performance across REITs. Since depreciation is deducted from revenues to determine net income, and depreciation is a non-cash expense, generally accepted accounting principles, net income underestimates true income for a REIT. Real property, if well located and maintained, is expected to appreciate in value. If property value should fall, decreases in value are likely to be correlated with depreciation entries determined using arbitrary cost accounting conventions. Gains or gains on the sales of properties are one-time events and not a component of recurring cash flow. Therefore, to calculate funds from operations based on net income, depreciation is added and one-time gains from sales of property are deducted. The result is an approximation of core cash flow earned by the REIT. Now, let's turn our attention to the adjusted funds from operations. Some analysts go further and calculate adjusted funds from operations. Funds from operation is modified by two items. The first is non-real estate depreciation and amortization, and the second is a straight line rent adjustment. Non-real estate depreciation and amortization includes depreciation of carpet, heating, ventilation, and air conditioning systems, appliances, the roof, and other assets in the building that actually do depreciate with use. Since these items have short economic lives relative to real property and likely must be replaced on regular basis, analysts include depreciation on these items as an expense. The straight line rent adjustment is a little more subtle and is a result of using the generally accepted accounting principles to define net income. In most leases, except for apartments, elsewhere, tenants sign long-term leases to occupy space. Leases often have escalation clauses whereby the lease amount increases annually at a pre-specified rate. For example, an office lease might include a clause that states that rents will increase at 3% per year over the base rate over a 5-year lease term. Rents of 20 Ghana cedis in the base year will grow. Generally accepted accounting principles for rents mandate that the average rent over the 5 periods be booked as income in each year. The sum of the annual rents will then become 106.18 Ghana cedis, and the average rent is 21.24 Ghana cedis. This is the number that must be used to calculate rental income for an income statement prepared under the generally accepted accounting principles, despite its having no basis in reality. In the early years of the lease, the generally accepted accounting principles rent overstates actual income earned. In the first year, it would be 20 Ghana cedis, but 21.24 Ghana cedis is reported under the generally accepted accounting principles rules. In the latter years, the generally accepted accounting principles rent understates actual rents earned. Therefore, to make adjusted funds from operations a more realistic measure of actual cash flow to the REIT, rents are adjusted. Let's have a look at an example. I will start the example with a table. This table presents an excerpt from the income statement of Washington Reit in 2006 through to 2009. Washington Reit, with a ticker symbol of WRIT or Reit, was created as one of the first REITs in 1960 and owns office, retail, and residential property in Washington, D.C. metropolitan area. The REIT prides itself on having increased the dividend in every year since inception, and in 2009 it paid $1.73 in dividends per share. The income statement shows that property rental income totaled $306.929 million in 2009. Revenue earned from other sources was $1.205 million, so that the total revenue from all sources, almost wholly rent, was $308.134 million. Expenses include interest payments on debt, operating expenses related to the ownership of the properties, depreciation and amortization, general and administrative expenses arising from operating the REIT, and other non-recurring expenses. Expenses total $208.986 million in 2009. And the difference between revenues and expenses, which is net income before gain on sale, is $26.148 million. Adding gains on sale of properties, the net income according to GAAP measures is $39.496 million. At the end of 2009, there were 56,988,000 shares. So net income per share was $0.69 per share. Applying the 90% pass-through requirement, REIT would be required to pay $0.62 in dividends. Instead, REIT paid a $1.73 dividend in 2009, which was 279% of what was required. Looking only at net income, it would appear that there was insufficient income available to shareholders to pay the dividend. However, net income was seriously understated, or net income can seriously understate the cash flow generated by a US REIT, and adjustments must be made. So let's look at these adjustments in terms of calculating the funds from operations for REIT. The calculation of funds from operations for REIT provides some insights into the difference between net income and funds from operations. Funds from operations calculations from 2006 through 2009 are presented in this table. Funds from operations in 2009 was $2.11. per share, which compares favorably with the $1.73 pence cents dividend that was paid. In fact, the dividend is only 82% of the funds from operations earned by the Reit. Now, to calculate the adjusted funds from operations, let's have a look at this table. To calculate the adjusted funds from operations, we must adjust rents back to their actual levels by subtracting the straight line rent and adding back non-real estate depreciations and amortization. As shown in the table, the Reit's adjustment to funds from operations for Reit in 2009 is $3,379,000 For Reit in 2009, the net adjustment from funds from operations to adjusted funds from operations is positive, and the adjusted funds from operations per share is higher than the funds from operations per share by 2 cents. These tables or these illustrations provide us with some understanding of the differences between net income, funds from operations, and adjusted funds from operations, and how to calculate them. I want you to take a critical look at the table, look at the components or the items and how they are adjusted to arrive at the respective measures of the income of a Reit. I will end this third lecture here and look at how to value Reits in the next lecture. Thank you.